Great. Thank you very much, Mark. As always, your comments are comprehensive and insightful. I couldn't help but notice those red marks on your last chart about affordability correlated pretty well with high climate risk, which is an issue that I think is worth bringing up here at some point. But I'll just start with the bulk of your presentation. Uh, your comments on, a modest correction, continued problems with affordability, I think ring largely true. I, can quibble a bit around the edges, but I think what would be most useful here is to get a little bit of details about your thinking in this regard, both from the perspective of U.S. housing policy, which is quite active area at the moment, and also some of the questions about capital markets developments and how things are changing in light of the higher interest rates. So with regards to policy, affordability has not escaped, or the lack thereof has not escaped the attention of the regulators, notably with regards to first-time home buyers. As a result, there is a lot of talk about fee cuts on the part of the agencies. For Fannie and Freddie, we're talking about their G fees and the LLPAs. Those are specified fees that maybe there will be some changes directed exactly at first-time home buyers, and at FHA for their mortgage insurance premium for the MIP. Do you think these changes are likely? Do you think they'll be effective? And do you think they'll help prop up demand in a difficult rate environment?
Richard, I think the probabilities of cuts in the FHA premium are higher than cuts in the Fannie Freddie G fee. I mean, you can make a case that FHA is doing very well financially, at least by the standards of FHA. The MMIF fund is in pretty good shape, and it has been for quite some time. We've kind of gotten to the other side of the pandemic and have a clearer vision of what the credit problems are. So I think you can make a case for a 25 basis point perhaps cut in the FHA premium. I say even odds though, because I think it has budget implications that I'm not sure the administration has budgeted for, and I'm not sure they can actually do it without accounting for that in some way. I'm not sure if that might be some kind of constraint on their ability to execute on that. Fannie and Freddie less. I think the probabilities are lower, and there I'm not even sure it's meaningful. We're talking basis points. We're not talking 25 basis points. We're talking basis points. So I'm not sure. It's kind of spitting in the wind. At the bond market, the mortgage rates move that. And take a look. They're moving like that in 1 minute. They move that much. So I'm not really sure that's going to make a big difference there. I think that if the policymakers really want to have an impact here, and I don't think there's much they can do immediately, but if they want to have an impact, they got to really focus on the supply side of this market. And if I were them, I'd be focused on tax policy, because you could, juice up LIHTC, that's the low income housing tax credit, which is key to the affordable rental market, or new market tax credits. I think I'm also the lead director of a large CDFI, and we love new market tax credits. So, good to know that I'm coming from that perspective. Or the new neighborhood home tax credit. The FHA director Julia Gordon, pioneered that pretty cool idea, and that might have some political traction. Republican Democrats tend to like, because the Democrats view it as a tax expenditure, Republicans view it as a tax cut. Maybe you get something through, and that could have an impact, within a year. And there's other things that can be done, but it will take a longer time to have any effect. But I don't know that premium cuts by FHA, Fannie, and Freddie are kind of going to make probabilities are about no more than even. And even if they do happen, I'm not sure that's going to change the dial here to a significant degree.
Right. I think in Fannie and Freddie's case, there's been more conversation about targeted cuts, like towards first-time home buyers, right? And the same point applies about how much will it have to do, but there's also the element that they, would be looking like they're actually, responding in some sense given, the constraints and what else they can do in a short period of time, right? So, I guess I think there's more of a chance that something will happen, but I don't disagree about how big an impact that will have. Along the same lines, and this is a little further afield, but there is all the concern in the housing policy space about inclusiveness and as far as it affects affordability, right? There have been programs for decades aimed at lower income and minority borrowers, but the situation in terms of their home ownership rates haven't really bridged the gap with the white population in any significant way since the Fair Housing Act was passed in the 1960s. Fannie and Freddie now have these programs that have been mandated by FHA, the Equitable Housing Finance Plans, which are designed to help underserved consumers attain and sustain home ownership. Fannie and Freddie just last month issued their reports on their plans for the next 3 years. So it's kind of a similar question. Do you think that these plans can have an impact on this important social issue? Do you think they can support the overall level of demand in the rate environment, or is that also not realistic to a very large degree?
Well, I mean, I think it's laudable that the FHFA now the GSEs are thinking along these lines and looking at this through a prism of inclusiveness. They always have, but I think they're doubling down, and I think it is obviously very important and useful that they experiment in different ways, and that I think is the intent of these special credit facilities, that they're vehicles that they're setting up to try to execute on these different ideas. So I think those are all good, but that's a long-term kind of development. I don't think it is. These are pilots. I don't know how easy or hard it's going to be to scale to really make a difference. So
Right.
here more broadly, this is I think an important point. I don't think we need. I think it's much more important that policymakers focus on the supply side of this market than the demand side of this market. The problem is supply. We need supply. And we've got a lot of restrictions on supply, some of which are long in the making, like what's going on with zoning and permitting. Some are more recent with the pandemic and the impact on supply chains and labor markets. And foreign immigration has been constrained, and a lot of those workers work in the construction trades in those parts of the country where we need a lot more supply. So if I, were king for the day, I'd be focused like on a laser beam on the supply side of this market. That's why I talked about those tax credits. I brought that up first because those are things that politically maybe, because you need legislation to really move the dial, and then start thinking about things where you have actual outlays and expenditures. If you go back to the Build Back Better agenda that President Biden put forward, part of that was housing supply. That had, as I recall, 150 billion over 10 years in housing supply, both tax credits and expenditures appropriations. And I thought, that's a pretty good way to go here to try to address the supply side issues. And then you got to start working on. And they had some creative. They put out a white paper. The administration put out a white paper on this issue maybe a month ago now, where they did identify some things, some carrots and sticks they're trying to use to get local governments to relax some of their restrictive zoning rules and permitting costs that make it very, very difficult to increase supply in in communities where it's obviously very needed, particularly for underserved communities. But I would say this is a big deal because home ownership, it's gone up, it's gone down, it's gone all around, but it's gone nowhere in 2 generations. And you're right. The white home ownership rate is, I'm making up the number, but it's close, 75%. The black home ownership rate is 45%. The Hispanic is 50%, and that's not going to change. And with demographics, the demographic trends that are underway, the aggregate home ownership rate, just simply take demographic shares, multiply by their current home ownership rate, it's going to fall. It's going to fall quite significantly. So we have to get a lot more creative on how to address this. By the way, this is an advertisement. I just wrote a paper with Mike Stegman and Jeb Mason on lease to purchase. So this is an idea to help take people from renters into homeowners and try to facilitate that process to address this question about how do we become more innovative in trying to figure out ways to get the minority groups, lower income households into home ownership. And it was just released this week, and people might find that of some value.
Yeah, that's great. I guess my personal concern is that these supply issues will themselves take a while, and that even though demand's suffering, it may not be enough to get you the kind of price adjustments that you need to alleviate some of the problems in the markets. And a growing use of arms, for example, is another aspect of that. But I don't want to keep going on. We have a couple of folks from the fund here who have some questions. Nina Biljanovska from the research department. Do you have a question or two for Mark?
Thank you, Mark, and thank you, Richard. So those were very important questions that you were raising on affordability, and we have been also working on affordability, but cross country. So very important topic, definitely. So I was thinking something along different lines than the questions of Richard, which is more like in terms of the comparison with the GFC. So we know that the current housing boom is characterized by much stronger balance sheets of both households and banks. So for example, household debt is not that high, at least in the US. Banks are well capitalized, lending standards are high, loans are issued to less risky borrowers, as you alluded to. So my question is like, if there is a correction, and as you mentioned, it's likely to be mild, but what are the risks that we should be watching after? What segments seem most vulnerable to you, and who and what is most likely to be affected?
So what you're asking, what indicators should I be watching to gauge whether the housing market or the economy is going in a negative direction?
So no, I think the question is more general, not very specific, like in terms of what sector, but we know that potentially there is a correction, and as you mentioned, it's going to be mild.
Yeah.
Like households are not very much indebted. I mean, that is like their fundamentals look strong, and also banks look well capitalized. So what are the risks that we should be watching from? So what is in your view?
I see.
Yeah, potentially, yeah.
So from a broader macro sense, what fault lines in the economy or financial system should I be focused on to exacerbate any kind of weakness or downturn that we are going to suffer?
Correct. Yes, and I think, I mean, based on your presentation, it seems like that there are like some areas that are overheating. So I don't know if like maybe specific segments, is it location, is it I don't know, specific sectors, specific segment of households that we should be concerned about. So because it's not trivial this time around. I mean, even if there is a correction, somebody will be affected by that. So my question is like, in your experience and by looking at the data so far, who do you think will be most vulnerable from a correction outcome?
Yeah, I don't think that I'd look to the housing market as that macroeconomic threat. There's the underwriting has been very good. The mortgage products have been pristine. Of course, the banking system has been put on very solid ground. I don't see, even in a 10% price decline scenario, significant increases in default, foreclosure, and distressed sale. And that's what you really need this thing to become a bigger problem for the issues in the housing market to reverberate back and cause bigger problems for the financial system and the real economy. So and generally the thing that does an economy in the last time isn't the thing that's going to do the economy the next time, because of all the reforms and changes and the memories. A lot of the people who are still managing companies in this space and regulators, they remember 10 years ago, It's just not going to, that's not where the problem's going to come from, I don't think. And broadly speaking, I feel pretty good about the balance sheet of the US economy and why it's one reason why I think we can avoid a recession. And if we do go into recession, why it will be relatively modest. There are a few stress points. You know, if I were looking on the consumer side, I'd be focused on the auto lending market. I mean, that's, you know, there's the old adage in banking, if it's growing like a weed, it's probably a weed. And that would apply to, you know, auto lending, particularly, you know, some lower quality auto lending. But even there, you know, used vehicle prices have gone skyward. So there's a lot of equity built in. So people can go delinquent, but they're not going to default and get repossessed on. So I think, you know, even there, the risk is relatively low. On the corporate side, I do worry leverage loans, although I've been perennially worried about leverage lending just because of the growth rates. But, you know, there are, I think, in a rising rate environment, there's potentially more stress there. So in the distribution of that debt is very barbelled. You got some folks that are in pretty good shape, some that aren't. So I think I'd focus there as well. But in broadly speaking, I feel pretty good. The only thing I'd call out is where I would be focused or paying some attention to would be kind of the non-bank, you know, part of the system. There, it's more about liquidity that could turn into a solvency issue. And the non-banks do play an awfully large role in the mortgage space. And actually, the Fed and the OFR and FSOC have done a pretty good job of, you know, shining a light on that. And I think we, you know, have a better grip on what's going on there. But nonetheless, if I had to pick something that I'd be focused on, that might be a stress point that could, you know, rock the system or the economy more broadly, it'd probably be the non-banks in the mortgage space where I'd, you know, be more focused.
Yeah.
Okay. I'm sorry, Nina. Do you have a follow-up?
Yeah, I have a follow-up question, not follow-up question, but actually another question in case there is time. So Prakash, please advise.
I think maybe we save that for when Denise comes on, and maybe turn to Adrian. I think he had some questions.
Yeah, Adrian, why don't you, Adrian Alter from the fund?
Thank you, Richard. Thank you, Prakash. And thank you, Mark, for the presentation. It was very interesting to see. It reminded me a bit of some work in the GFSR we've done some time ago on house prices at risk. Yeah, so my questions are related a bit to some of this demand that you have mentioned in your presentation. So you mentioned the flippers. Perhaps during the pandemic, we have seen also second home buyers in cash. You also mentioned the institutional presence in the residential housing market. Those e-buyers or iBuyers that started to purchase big quantities like Zillow and others, and then started to sell that based on their models. So I was wondering to what extent some of these non-traditional buyers are sensitive to interest rate changes, and whether some of them will come up in case of a downturn and prop up prices.
Yeah, I'm generally sanguine is the word, I think, with regard to investors and the housing market, in part because, as I showed, the flipper share, which are their short-term investors, is a very small part of the market and has remained so. Second, the kind of longer-term institutional investor, I think I might have mentioned this in my presentation. I don't think they're going to sell. They will stop. They've already stopped buying. You know, if you talk to them, they've stopped buying because they believe that they can get a better price 6-12 months from now. And they're in those markets where I think prices are going to decline. So that's probably, you know, a wise kind of investment strategy. But these are long-term business, durable business models. They've raised a lot of capital, and I think there's a lot of room to run here for them, unless they get derailed by policy in some way. But that I have a hard time figuring out how that would happen. So I think they're not going to sell. So I view them as, you know, contributing to the recent decline in home sales, but I find them as a more durable, source of support to the market. And they'll come in when they sense that opportunity, when prices are down 5, 10, 15% in Phoenix or in Jacksonville. The second home buyer, I think, there's going to be some weakness there, but I think generally these are high income, high net worth households, a lot of foreign buyers that have a lot of financial resource. Yes, the stock market is down. Yes, crypto is down, and that will take some of the steam out of that second vacation home market. But there's, I think there's plenty of wealth there and plenty of demand. And I don't view that as these folks are going to be big sellers. And I think there's probably some pent up demand there, actually. I could sense that people are waiting for opportunity because prices have gone skyward in these second vacation home markets. So I generally view what's going on with the investor demand as neutral to positive to the housing market. I don't view it in the context of the correction that we're experiencing and will experience over the next couple of 3 years. I will say one other thing, though. Institutional investors are going to be a problem, back to my point about home ownership. Another reason why home ownership is going to decline is because institutional investors are going to become owners. That is a good business model. And, if you go to the multifamily market, that's already been institutionalized. They have now figured out how to institutionalize a single family market. They got scale. They've got a structured finance market that's operating. They got capital, from multiple sources. This is a real business model that has legs. So I think the single family market is going to continue to be institutionalized. And again, those institutional investors are only a few percentage point of the market. They got a national market that bigger in some parts of the country, but that they have a long way to run. And that's going to be another downward pressure on home ownership, and another reason why we have to focus on supply, because unless we get more supply and rent growth and house price growth remains strong, that's just going to make it even more attractive for those institutional investors to continue to pursue that business model, and to the detriment of home ownership.
That's absolutely a great point, and part of the concerns that I was expressing about there's still a lot of sources of demand. But in any event, thank you